What if every month started with money arriving in your account before you lifted a finger? No overtime, no extra shifts, no second job. Just income generated from investments you already own. For millions of people, that idea represents the ultimate financial goal. Not because they never want to work again, but because they want options. They want the freedom to decide how they spend their time without constantly worrying about their next paycheck. One of the most popular ways investors pursue this goal is through dividend investing. Dividends can provide a steady stream of income while allowing investors to continue owning their assets. Instead of selling investments to generate cash, shareholders receive regular payments simply for holding qualifying investments. But how much money would it actually take to generate meaningful income from dividends? In this video, we're going to examine a target of approximately $3,500 per month, which equals about $42,000 per year. We'll explore 3 different income-focused investment approaches that many investors use, discuss the advantages and drawbacks of each, and estimate how much capital may be required to reach that income level.
Remember, this video is for educational purposes only and is not financial advice. Investment returns are never guaranteed, and all investments involve risk. Let's start with the foundation, understanding how dividends work. When you buy stock in a company, you're purchasing a small ownership stake in that business. If the company earns profits, management can choose several paths. They may invest in future growth, reduce debt, buy back shares, or distribute a portion of those profits to shareholders. That distribution is called a dividend. Think of it like owning part of an apartment building. If the building generates profits after expenses, owners can receive a share of those profits. Dividends operate in a similar way. Many dividend-paying companies distribute cash every quarter, though some pay monthly and others pay annually. Investors often evaluate dividend opportunities using a metric known as dividend yield. Dividend yield measures the annual dividend payment compared to the investment's current price.
For example, if an investment costs $100 and pays $5 per year in dividends, its dividend yield is 5%. A higher yield can mean more income, but it can also signal higher risk. That's why experienced investors rarely make decisions based solely on yield. Instead, they consider the financial health of the company, the sustainability of the dividend, and the overall quality of the investment. Now let's look at 3 different approaches investors often use when seeking income. One increasingly popular income strategy involves covered call exchange-traded funds, commonly known as covered call ETFs. These funds are designed to produce income in 2 ways. The first comes from the stocks they own, while the second comes from collecting option premiums through covered call strategies. Without getting overly technical, covered calls involve selling options contracts on stocks already held within the fund. In exchange for granting certain rights to option buyers, the fund receives premiums. Those premiums can then be distributed to shareholders as income.
This additional source of cash flow often allows covered call ETFs to produce higher yields than many traditional dividend stocks. For investors who prioritize steady income over maximizing long-term growth, these funds can be an appealing option. One of the biggest advantages is their potential to generate higher income than traditional stock investments. They also tend to provide regular distributions, making cash flow more predictable for investors. And because these funds are structured as ETFs, they offer built-in diversification while eliminating the need to research and select individual stocks. But these benefits come with important trade-offs. Covered call strategies can generate additional income, but they may also limit gains during strong market rallies. As a result, investors could miss out on some of the upside that comes with rapidly rising stock prices. And while the income may be attractive, these funds are not immune to market risk. If the underlying stocks decline in value, the ETF can still experience losses. That's why covered call ETFs should be viewed as income-focused investments, not risk-free income machines. Let's assume an investor owns a portfolio generating roughly 11% annually. To generate approximately $42,000 per year, this investor might need around $380,000 invested to produce roughly $42,000 annually before taxes and assuming distributions remain stable. That's significantly less capital than many traditional dividend approaches require. For income-focused investors, this is one reason covered call ETFs have become increasingly popular. The second approach involves real estate investment trusts, commonly called REITs. REITs allow investors to participate in real estate ownership without directly buying properties. Instead of purchasing apartment buildings, shopping centers, warehouses, office complexes, or healthcare facilities yourself, you can invest through publicly traded REITs. These companies own, manage, and often develop income-producing properties.
By law, many REITs distribute a substantial portion of their taxable income to shareholders. This often results in attractive dividend payments. Why investors like REITs? Real estate has historically played an important role in wealth creation. Properties generate rental income, and many increase in value over time. REITs provide exposure to these benefits while avoiding many of the headaches associated with direct property ownership. You don't have to handle repairs. You don't have to collect rent. You don't have to manage tenants. Everything is handled by the REIT management team. Of course, REITs face challenges too. Economic slowdowns can reduce occupancy rates.
Interest rate increases can impact financing costs. Changes in consumer behavior can affect certain property sectors. For example, retail-focused REITs may face different challenges than industrial warehouse REITs. As a result, not all REITs perform equally. Suppose a diversified REIT portfolio generates an average annual yield of approximately 10%. To produce $42,000 annually, an investor would need approximately $420,000 invested. One attractive feature of many REITs is their monthly or quarterly distribution schedules, which can provide consistent cash flow. For investors seeking income while maintaining exposure to real estate, REITs remain a popular option. The third approach focuses on dividend growth investing. Instead of chasing the highest yield available, dividend growth investors often prioritize companies with long histories of increasing their payouts.
These businesses tend to be mature, profitable, and financially stable. Many operate in industries that generate reliable cash flow year after year. For examples, consumer goods companies and healthcare businesses. The goal isn't necessarily maximizing current income. The goal is creating a growing income stream over time. Imagine receiving a $2,000 annual dividend today. Now imagine that dividend increases every year. After 10 or 20 years, your income may be substantially higher than when you started. This growth can help investors combat inflation and maintain purchasing power. These investments offer several advantages that appeal to long-term income investors. The biggest downside is that the initial yield is often lower compared to some higher-yield investment alternatives. Investors may need more capital to generate the same immediate income.
Assume a portfolio yields approximately 7%. To generate $42,000 annually, an investor would need approximately more than $500,000 invested. While that requirement is larger than the previous strategies, many investors appreciate the stability and long-term growth potential these businesses may offer. Let's compare our simplified examples. Covered call ETFs. Estimated yield, 11%. Capital needed, approximately $380,000. REIT portfolio. Estimated yield, 10%. Capital needed, approximately $420,000. Dividend growth stocks. Estimated yield, 7%. Capital needed, approximately $600,000. At first glance, higher yield strategies appear more attractive because they require less capital.
However, yield alone should never determine your investment decisions. Higher yields frequently come with additional risks. Lower yield investments may provide stronger growth potential and greater dividend sustainability over the long run. Many successful investors combine multiple strategies to create balance. Rather than relying on a single income source, they build diversified portfolios that include various asset types. Regardless of which strategy you prefer, reaching meaningful dividend income usually comes down to a few key principles. 1. Invest consistently. Consistency often matters more than timing. Regular contributions can gradually build a larger investment base over time. 2. Reinvest early dividends.
During the accumulation phase, reinvesting dividends can significantly accelerate growth. Your investments generate income. That income buys more investments. Those investments generate additional income. This creates a powerful compounding effect. 3. Diversify. Avoid concentrating your entire portfolio in a single stock,
sector, or investment type. Diversification can help reduce risk and improve long-term resilience. 4. Focus on quality. A high yield is meaningless if the dividend is eventually cut. Financial stability should always be part of the evaluation process. Think long-term. Building substantial passive income rarely happens overnight. Most successful dividend investors spend years steadily growing their portfolios. Patience can be one of the most valuable assets an investor possesses. Living on dividends is a goal many investors pursue because it offers something incredibly valuable: financial flexibility. Whether your target is $1,000 per month, $3,500 per month, or even more, the basic principle remains the same. Build a portfolio of income-producing assets. Allow those assets to generate cash flow. Stay disciplined, stay patient, and continue investing consistently. Covered call ETFs, REITs, and dividend growth stocks each offer different paths towards creating passive income. None are perfect, and each comes with its own risks and rewards. The best approach depends on your goals, risk tolerance, time horizon, and overall financial plan. The important thing is getting started and developing a strategy that you can follow for years, not weeks. Because financial freedom isn't usually built through dramatic moves. More often, it's built through small, consistent actions repeated over time. If you enjoyed this video, consider subscribing and checking out our other content on investing, passive income, wealth building, and financial independence. Thanks for watching, and we'll see you in the next video.